Welcome to this video from Kepsfield Academy. In this first video, we will explore what the definition of business valuation means, its uses and importance, the various valuation methodologies, and how to interpret valuation results. Think of business valuation as the process of estimating a company's worth, just like you might appraise the value of a house before buying or selling it. Business valuation aims to provide a fair estimate of a company's economic value, considering its potential to grow and make money. Valuation is a much-covered topic in finance. It is crucial in many different fields because it helps us make informed decisions in areas like investing in stocks or buying and selling companies. It's also important for businesses themselves as they try to grow and create more value for their owners. Plus, valuation is used in legal and accounting situations, such as determining the value of assets during a bankruptcy. Just as one might evaluate the value of a residential property by comparing it to other houses in the same vicinity or by estimating the cost of its reconstruction, similarly, we have multiple methodologies to assess the economic value of a company. These methodologies involve analyses that target the intrinsic worth of the company, as well as those based on the comparative market values of similar businesses. Additionally, there are valuations grounded in accounting or book values, and those based on the estimated costs to establish a comparable company or asset. In practice, the methods of intrinsic and relative valuation are often applied simultaneously to provide a comprehensive understanding of a company's value. In this course, our emphasis will be on the strategies of intrinsic valuation. The discounted cash flow, DCF, method is the most commonly used intrinsic valuation method. This method looks at a company's future earnings potential to determine the value. Imagine you have a house that can generate rental income for several years. The DCF method helps you estimate how much that house is worth today by considering how much money it will make in the future and how much that money is worth today. We'll explain this concept in more detail later in the course. In contrast, a relative valuation evaluates the worth of a target company by comparing it to the value of other similar companies. The most popularly utilized techniques in relative valuation are the comparable trading analysis and the comparable transaction analysis, often collectively referred to as multiple valuation. Picture this as assessing a house's worth by comparing it with other similar properties in the neighborhood and determining your offer based on those comparative values. It is crucial to distinguish between value and price. As famously quoted by Warren Buffett, "Value is what you get, price is what you pay." Price is the result of transaction negotiations, while value represents the present worth of future benefits the company is expected to yield. Therefore, a valuation based on intrinsic value is fundamentally an analysis based on value, whereas a relative valuation is contingent on price. When conducting a valuation analysis, it is vital to acknowledge this distinction and employ both methodologies to cross-verify your results. Business valuation results can be subjective because they're based on assumptions about the future. To get a clearer picture of a company's value, it's a good idea to consider different scenarios and use different valuation methods. The findings can then be visually represented in a compelling chart known as a valuation football field, which facilitates easy comparison and summarization of different valuation technique outcomes. Want to fast-track your finance career? Explore our practical, comprehensive courses at www.kepsfield.com and accelerate your career today.